Hi, if you've been reading the news, you've probably come across some headlines about perpetual bonds and debt mutual funds, and you may be wondering how this impacts you as an investor. So in this video, we're going to be talking about a new guideline that has come in from SEBI regarding perpetual bonds and how mutual funds should be investing in them. We're going to talk about the impact that it has on your portfolio and how as an investor you can respond to this situation. Now, the first thing is that we need to understand what perpetual bonds are. They've been in the limelight for the last couple of years because last year we had Yes Bank perps being written off. We've also had Lakshmi Vilas Bank's perpetual bonds also been written off. And that was the first time where we've seen debt investors lose on a bond. So perpetual bonds are issued by banks for their capital requirements, and they are quasi-debt and quasi-equity instruments. So this basically means they have loss absorption features for the bank. So this makes it a little riskier for investors to be investing in them. And in an effort to protect investors, SEBI has come up with these guidelines. So what exactly does the notification say? It says that firstly, any fund where the fund manager is going to be investing in perpetual bonds, the scheme information document should have a provision for a segregated portfolio. So segregated portfolios in the past have been used where there's been a default, so that when the money comes back for that particular bond, it is in a separate portfolio and it doesn't trigger a rush of exit in terms of investors, and it protects all investors equally. Now, it also clearly states that it's up to the asset management company or the mutual fund house to decide whether they want to put the perpetual bonds into the segregated portfolio or not. But it just mandates that the fund house must have the segregated portfolio concept in its scheme information document. Then it also outlines what are the investment limits that a mutual fund can have towards these perpetual bonds. So the first thing that it says is at an asset management company level, they cannot have more than 10% exposure to perpetual bonds. The second thing that it says is that in a particular scheme, also the exposure to perpetual bonds cannot be more than 10%. And towards a particular security, this should be less than 5%. So keeping all of these conditions in mind, it ensures that there isn't too much concentration risk and that overall the exposure towards perpetual bonds is reduced. Now, the next point in the circular is that these perpetual bonds should be valued on the basis of their maturity being 100 years. So perpetual bonds in nature don't have a fixed maturity, so they don't mature say 5 years down the line or 10 years down the line. And so far, fund managers as well as the market has been valuing them on a model known as yield to call. So although the bond does not have a maturity date, there will be a date where the bank can call back those bonds and repay investors. And this is less than 100 years. In fact, it's typically 3 to 5 years. So now if you're going to value a bond at 100 years, it makes that portfolio that much more volatile. It also reduces the yield, which means that a particular fund manager may have to mark down the value of the bond, and that could show up as a lower NAV for an investor. So there are some problems associated with this, and that's why you're seeing all of these headlines in the newspaper. Now, if there is a markdown on the bond value, then you will see a lower NAV, and conservative investors, when they see some volatility in their bond portfolios, might feel scared and exit these funds. Now, when this happens, that could trigger more investors to want to exit, and that would create a sort of ripple effect and affect both the investors who leave as well as the investors who choose to stay behind. The second thing it does is create more volatility in debt portfolios, where traditionally the kind of investors who are coming into the debt mutual funds are used to instruments like fixed deposits, where the returns are steady and there is no change in capital. If fund managers have to be valuing these securities on a regular basis and that valuation keeps changing because these securities are not traded that much, then you would see a lot more volatility in your portfolio, and that may not be what a lot of investors are signing up for. Now, from a capital market perspective also, there are certain problems that are posed. For instance, mutual funds are one of the biggest buyers of perpetual bonds in the market. So putting these limits on how much they can own would reduce the appetite for perpetual bonds in the market. It would also mean that banks would find it very difficult to raise capital through perpetual bonds, and this is something that they need as well. Now, this is up for debate, and in fact, the finance ministry had written to SEBI after the circular came out, saying that this was disrupting the market. AMFI also responded on a positive note to SEBI's circular, saying that it was the right move in terms of investor protection. Now, we don't know exactly what is going to happen because all of these changes are supposed to come into effect on April 1st, and SEBI has not yet responded to the finance ministry. Now, as an investor, what is it that you should be doing at this point? The first thing that you need to understand is that there is no reason to panic and exit your funds. A lot of mutual funds do have exposure to perpetual bonds. These include categories like banking and PSU debt funds, which are considered to be very safe. It may also include medium duration funds or credit risk funds. So talk to your advisor about what you should be doing with your investments before you decide to exit them or scale them up. You can get a portfolio review done with us. All you have to do is send us your NSDL and CDSL statements to info@ithought.co.in, and we'll be happy to send across a quotation and start working with you right away. Do get in touch with us. We hope you found this video helpful. If you have any questions, please comment them below and we'll be happy to answer it. Do remember that these regulations kick into effect on April 1st, and don't make any hasty decisions while you're trying to grow your wealth. Thank you.